By the last week of October 2025, London got hit with an unexpected wave of silver 660 tons routed into the LBMA network. On paper, that kind of supply should smash the price. On my screen, the tape refused to break. That Friday wasn't just another session. It was month end. The stretch of days when London's OTC world turns into a story factory. Flows get summarized. Settlement gets dressed up as confidence. And the public is handed a clean narrative. Supply arrived. Pressure is easing. The market can breathe again. I don't trust month-end narratives. I trust timing, behavior, and constraints. When I first saw the number circulating in the back channels, what struck me wasn't the tonnage alone. It was the word attached to it, unexpected. Markets use that word when they're trying to make an intervention look like an accident. A genuine surplus doesn't need euphemisms. It shows up as sellers competing and buyers backing away. So I built the picture the way I always do when something feels staged. I reviewed the chatter around routing points and settlement windows. I looked for the quiet confirmations that never make it into headlines. I noted who was speaking with confidence and who was speaking in careful fragments. Then I asked the simplest question that cuts through all of it. If 660 tons hit the LBMA network, why didn't price behave the way it's supposed to? On paper, a wave like that should have produced a clean downward cascade. You would expect the bid to step aside, spec longs to flinch, and the chart to show a moment of surrender. Even a market that recovers later usually leaves a bruise. And that bruise is how you know the supply was real. I pulled up spot and front month action and watched the tape with the kind of attention most people reserve for breaking news. There was volatility. Yes, but not the panic kind. The bids didn't evaporate. They refreshed. The market moved like it was being guided through a narrow corridor, not like it was being hit by a tidal wave. A market can only absorb an outsized supply shock without flinching if something deeper is already tight enough to override the headline, or if the shock isn't a true release of free metal, but a controlled flow meant to keep the mechanism working without resetting the entire curve. That's where the bullion bank complex enters the frame, not as a cartoon villain, but as an architecture. Market makers exist to provide continuity, to smooth price action and keep the experience of liquidity intact. The problem is what continuity looks like when deliverability is deteriorating underneath. Because the LBMA network is not a retail store, it's a settlement ecosystem. It can appear flush even while the marginal bar becomes harder to source. It can keep a reference price looking orderly while physical conditions quietly tighten. That's exactly why London is such a powerful stage. It allows the world to confuse a clean price with a clean supply. I didn't want to theorize. I wanted to test the one metric that refuses to play along: delivery. So I called a wholesaler I trust, the kind of operator who doesn't have time for narratives. He gave me a quote without hesitation, spot linked. Perfectly reasonable. Exactly what my screen said it should be. Then I asked the only question that matters when a market is under strain: can you actually deliver it? There was no confession, no rant, just a subtle change in posture. The way professionals talk when the answer is complicated and they're trying not to sound alarming. He could quote, but he could not guarantee immediate fulfillment without conditions. Not unless I accepted a delay. A smaller size, or a priority window. The language was polite, but the meaning was blunt. Availability had become conditional. That is not what abundance sounds like. In a well-supplied market, the conversation is about price competition and fast fulfillment. In a tightening market, the conversation is about scheduling and who gets served first. The quote stays clean, but the deal picks up friction. The retail side was already sensing it. Stackers don't need a Bloomberg terminal to detect stress. They detect it at the counter, in lead times, in the premium that refuses to compress, and in the way dealers stop encouraging bigger orders when the headline says flood and the street says wait. Suspicion hardens. The moment most people miss is the Sunday reopen, when futures reprice with thinner liquidity and less narrative cover. If 660 tons truly represented relief, You would expect that reopen to feel heavy and offered. Instead, the tape still refused to break. The market stayed guarded and controlled, as if the bid wasn't a mood but a necessity. That was when I stopped treating the month-end unexpected wave as a victory headline. I treated it as damage control that didn't achieve its primary objective. If an intervention-size flow can't impose fear on the chart, then the problem isn't sentiment. The problem is structural tightness underneath the paper layer, and structural tightness forces the truth on its own schedule. So I rewind to January 1, 2025. Because no country spends a bullet like this at month end unless something behind the curtain is already on fire. On Wednesday, January 1, 2025, Beijing put silver exports under state approval like a strategic resource. The world called it leverage. I called it a hospital bracelet, triage. What I watched in London at month end wasn't the beginning of the story. It was the symptom. A 660-ton shock that should have forced a clean break in price, but didn't. Symptoms are easy to argue about. Causes are harder, because causes live in places that don't care about anyone's narrative. So I rewound to the first clean timestamp in this file, Beijing's policy signal. State approval sounds procedural until you translate it into market language. It means the faucet is no longer purely commercial. It's discretionary. It can be tightened or loosened based on conditions the public won't see until later. Commentators treated it like leverage, as if China woke up and decided to threaten the world with scarcity. But leverage is what you do when you have excess capacity and patience. Triage is what you do when you have constraints and priorities. Paperwork is often a confession in disguise. If you truly control abundance, you don't need to formalize permission. You build approval gates when you're trying to manage internal stress without admitting you have it. And China's internal stress driver is obvious: industrial demand that doesn't negotiate. Solar manufacturing, electronics, fabrication supply chains that need silver as an input, not as a trade. These industries don't care what a headline says about a flood of supply. They care whether procurement can secure metal on schedule, at scale, without delivery risk. That's why I didn't stop at Beijing's language. I went to Shanghai, because Shanghai is where policy meets constraint. On Thursday, Dec 11, 2025, I pulled up the visible SHFE warehouse picture. I treat that data like a scoreboard, imperfect, but stubborn. The trend didn't look like hoarding. It looked like erosion. Not a single cliff, not a clean event, but a persistent drawdown pattern that ends in late 2025 with visible stock that feels too thin for a system of China's scale. Then, the second proof arrived, and it speaks louder than any press release. The premium Shanghai paid over Western pricing. A one-day premium can be noise. A sustained double-digit premium is a signal. Premium is the market pricing certainty, the surcharge on immediacy and physical availability. When the local market keeps paying up, it's telling you that the global price is a reference number, not a guarantee of deliverability. This is where the official narrative starts to collapse. If China's export controls were a dominance play, you would expect domestic comfort to increase over time. Visible buffers would stabilize or rebuild, and local stress signals would ease. Instead, the visible picture tightened and the premium stayed stubborn. That combination does not describe leisurely hoarding from surplus. It describes a system trying to keep its industrial base supplied while managing a constraint. Another silent factor was pulling on the same limited pool of metal, India. It does not need to broadcast its demand to be consequential. It absorbs. It imports. It acts like a vacuum on free float. In a market as small as silver, that vacuum doesn't have to be loud. It just has to be persistent. Now put that together with what I saw in London. When Shanghai is paying up for physical and visible buffers are thinning, as a sudden month-end flow into the LBMA network stops looking like a strategic flex and starts looking like an emergency maneuver. Sometimes a country exports in size not because it is comfortable, but because it cannot afford for the pricing mechanism to break. London is not merely a market. It is a reference engine. If London's settlement system seizes, you don't just get a higher price. You get a credibility crisis. You get decoupling. You get a world where the paper layer and the physical layer openly disagree. And once that becomes public, the entire structure has to reprice around deliverability rather than convenience. That's why October reads differently when you look at constraint data instead of commentary. Routing 660 tons toward London at month end, after putting exports under state approval earlier in the year, is not consistent with a simple dominance narrative. It is consistent with damage control, a supplier of last resort move intended to keep London functioning long enough for the system to regain order. But it didn't regain order. The price behavior didn't cooperate, and delivery conditions stayed sticky. That is what happens when the underlying shortage is structural and the intervention is temporary. Policy didn't explain the market. The market explained the policy. If China had to bleed metal to keep London functioning, then the real power isn't in policy, it's in the mechanism that kept the paper price from screaming earlier. Next, I open that machine. Here's the trap. The global silver price is optimized for trading, not for delivery. And when delivery tightens, the system doesn't admit scarcity. It reaches for emergency levers that look like protection and feel like a setup. By this point, I had enough evidence to stop arguing with commentary. I had the month-end anomaly that failed to break the tape, and I had the Shanghai stress signals that didn't match the China is hoarding for leverage storyline. The only thing left was to explain how the price can stay orderly while the physical market tightens underneath it. That explanation is not mystical. It's plumbing. The global silver price is a reference number built to facilitate trading. It is excellent at producing liquidity, tight spreads, and a continuous quote. It is not optimized to guarantee that every unit of paper exposure can be converted into immediate physical delivery. That distinction sounds academic until you live through a squeeze. And then it becomes the only distinction that matters. Start with the structure. COMEX futures and LBMA forwards give the world a clean, tradable benchmark. Bullion banks sit between buyers and sellers as market makers, providing quotes and absorbing flow. Clearing and margin rules sit above all of it as the referee, with the power to change behavior overnight without ever changing the underlying availability of metal. That is why I keep repeating a line that people love until the day they hate it. The screen sells promises, while the vault sells metal. Most of the time, the difference is invisible, because the system is built to net, ARL, and settle exposures efficiently. Futures can be closed, rolled forward, or offset against other positions. Forward exposure can be netted. Paper can recycle itself. Physical cannot. Physical has to be sourced, refined, moved, and settled through a chain that has limits. When those limits tighten, a real market would normally signal that stress by repricing the near term. The term structure begins to speak, and it does so with a word most casual investors never hear until it is too late. Backwardation is that word. Backwardation is when near-term metal is priced higher than later delivery. It is the market paying you to give up immediacy and wait, which is the exact opposite of what a healthy curve wants to do. In plain English, it is the system telling you the metal is more valuable right now than it is later, because the market is increasingly unsure it can meet near-term demand without rationing. Now, layer in timing, because timing is where a tight market turns into a violent market. On Friday, March 20, 2026, COMEX OPEX week turned the entire paper layer into a pressure chamber. Options positioning is not just a sideshow, it is a mechanical amplifier. When price approaches major strikes, option dealers hedge to stay neutral. That hedging is forced flow. If price rises through key levels, dealers can be pushed into buying more futures to offset their exposure. That buying can push price higher, which forces more hedging, which pushes price higher again. That feedback loop is gamma squeeze. It is not driven by sentiment or retail enthusiasm. It is driven by the mathematics of hedging. In a normal market, gamma can create a fast move, but it usually burns out because supply responds and the curve stabilizes. In a tight market with backwardation, pressure, and stubborn premiums, Gamma is not merely a rally engine, it becomes an accelerant. It can drag the reference price toward a level where the system has to decide whether it will admit scarcity or manage it. That decision is where the trap closes. When deliverability tightens, the system rarely announces. We are short physical. It reaches for levers that can change behavior without admitting the underlying constraint. It uses the language of stability and protection because stability is the product the paper market sells. So the levers appear, margin requirements rise, position limits tighten, settlement guidance becomes prudent. The rhetoric frames it as risk management. The effect is always the same. It targets leverage first, because leverage is the easiest thing to break. In my notes, I label that reflex a risk control protocol I call Rule 4. 7b. It is a fictionalized name for a very real pattern, an emergency stability clause that becomes relevant only when the market is stressed enough that the referee needs to change the game without changing the headline. Rule 4. 7. B does not have to ban anyone or accuse anyone. It simply raises the cost of staying in the trade. When margin hikes hit overnight, levered longs are forced to reduce risk. They sell because they have to, not because the fundamentals changed. The chart often looks calmer afterward, and people mistake that calm for resolution. But the physical market does not resolve on margin notices. Premiums do not compress because a clearing memo went out. Lead times do not shorten because position limits tightened. Backwardation does not disappear because traders got shaken out. Those signals care about one thing: whether metal can be sourced and delivered. This is the wealth transfer moment the system never describes honestly. Forced selling happens in paper. Quiet accumulation happens in physical. The system calls it orderly risk management. I see it as asset transfer under stress, because the weak hands being washed out are almost always paper hands, while the people who can hold through it are the funded, prepared holders who care about deliverability. That is why the October 2025 month-end event finally made sense to me in a darker way. The 660-ton unexpected wave was not meant to permanently cap price. It was meant to buy time. Time for margin regimes and stability tools to flush leverage and keep the paper mechanism from having to reprice the physical shortage all at once. But backwardation and premiums don't respond to time buying the way headlines do. They respond to metal. They respond to constraints. They respond to the real demand that keeps pulling bars out of the system whether the chart looks calm or not. Once the margin trap fires, the next phase isn't a chart story. It's an industry story because silver isn't a luxury metal. It's a component. And when components go scarce, the real panic begins. The screen can quote you a price in milliseconds. The physical market answers slower because it's running out of metal. When premiums stay elevated and delivery gets allocated, that's not volatility. That's a confession. After March OPEX week, the paper layer looked like it had done its job. The chart still moved, still traded, still offered the comforting illusion of endless two-way liquidity. But the real story wasn't on the candle. It was in the conditions attached to the deal. And those conditions started showing up everywhere at once. Between January and April 2026, I kept hearing the same vocabulary from people who normally never need it. The first time was on a U.S. wholesaler desk. I asked for a quote and got one instantly spot-linked. Clean. Professional. Then I asked for delivery terms, and the tone shifted in a way that doesn't show up on any dashboard. Limited availability. 2 to 3 week lead time. Priority clients first? That last line is the tell. In a healthy market, price is the filter. In a stressed market, access becomes the filter. And money buys you a place in line instead of a guaranteed shipment. When the word allocation enters the conversation, it means supply is no longer responding smoothly to demand. It's being rationed with polite language. I went to a coin shop next, because retail is a pressure gauge that doesn't lie. The posted spot price looked calm enough to reassure anyone who only watches screens. The premium on anything deliverable told a different truth. Trays were thinner than they should have been. Product that used to sit became, if you want size, we'll have to order it. Customers weren't asking for a thesis. They were asking whether anything was left that could be taken home today. That is how FOMO actually arrives. Not as a meme, but as a change in questions. People stop asking, is it a good price? And start asking, can I get it? What made the situation more dangerous was that the pressure wasn't coming from one corner of the market. It was coming from the non-negotiable side industrial demand that treats silver as a component, not a discretionary purchase. Procurement desks don't care about narratives, and they don't wait for the chart to confirm anything. They pay for certainty because downtime costs more than premiums. Solar buildouts, EV infrastructure, and AI data center construction don't need silver because it's fashionable. They need it because performance requirements and physics keep narrowing the substitution options. That's the point where silver becomes unobtainium, not as a slogan, but as an operational problem. It's still a commodity on paper, but it starts behaving like a constrained input where the real price is measured in lead times and contract language. Shanghai kept reinforcing that message. The persistent double-digit premium there wasn't simply a local quirk. It was a stress signal. It told me that even when a global reference price looked stable, the regional market closest to heavy fabrication demand was still paying extra for immediacy. That premium was the market putting a dollar value on certainty, and certainty was getting more expensive, not less. In London, the tightening was quieter but just as telling. Settlement plumbing doesn't announce itself. It shows up as longer turnaround, smaller lots moving with more scrutiny, and a growing sensitivity to who is entitled to what and when. A system can look liquid right up until the moment someone demands size and immediacy at the same time. This is where the comfort trap becomes gasoline. When the street feels tight, the crowd looks for the cleanest shortcut. The chorus gets louder. Don't worry about premiums. Don't worry about delivery. Just buy the ETF. It's liquid. It's instant. And it feels like the safest way to participate without the friction. But convenience is not deliverability. Exposure is not the same thing as possession. In a tightening physical market, the instrument that feels easiest can also be the instrument most disconnected from the one constraint that is actually driving the stress, the ability to source metal without conditions. India's role in that stress is the part that stays underestimated until the free float is already gone. In the narrative data, the import wave roughly 600 tons across September and October 2025, wasn't just a shocking number. It was proof that supply can be absorbed quietly through ordinary channels, without a headline announcing the drain. When a vacuum like that persists, it doesn't need drama to move the market. It simply reduces the buffer everyone else assumed was there. And the math beneath the behavior does not reset. Recurring deficits, including the cited 215, 3 million ounce deficit in 2024, don't disappear because someone points to one dramatic shipment or 1 month of flows. They resolve through new supply, which is slow, or demand destruction, which is violent. That's why the October 660-ton injection failed to restore normal behavior, and why premiums refused to compress even when the chart looked manageable. The conditions were tightening because the underlying imbalance was still there. When a market starts rationing on the street while maintaining liquidity on the screen, the next escalation is almost never a voluntary confession. It's administrative. It's procedural. It's framed as stability. When the street is rationed and the screen is still liquid, the next move is always the same. The system tries to force calm with rules. And that's when the market reaches the stage nobody likes to name out loud force majeure. People think markets break on bad news. I've learned they break on schedules when options, margin, and delivery windows collide. In silver, Judgment Day looks like a quiet email from clearing right before the Friday close. By midweek, the physical side had already done what paper refuses to do. It told the truth through conditions. Premiums stayed stubborn. Allocation language spread. Lead time became normal. And once that happens, the paper layer doesn't adapt by admitting scarcity. It adapts by defending itself. I've learned to watch the calendar the way other people watch headlines. Because in OPEX week, The market stops being a debate and becomes a set of forced behaviors. Nobody has to believe in anything for the price to move. The structure does the moving. Into the June 2026 quarterly expiration, price kept leaning into the strikes that mattered. I could see it in the positioning and in the way the tape behaved around round numbers. Dealers who sold options weren't making predictions. They were managing exposure. As spot pushed higher, their hedges had to change. They bought to stay neutral, and that buying pushed price higher, which forced more hedging. Gamma isn't a narrative. It's a loop, and loops don't care who you voted for, what you think China will do, or what CNBC is smiling about. New York looked busy on the surface. Screens were liquid. Spreads were tight. Commentators sounded relaxed because the chart still looked tradable. But on risk desks, the tone was different. The professionals weren't debating direction anymore. They were debating time. Because once Gamma starts feeding itself, shorts lose the one resource they can't borrow: days. At first, they think in terms of profit and levels. Then they switch to survival math. How much margin do I need if price gaps? How much can I cover without moving the market? What happens if the curve keeps hinting at backwardation and the nearby metal stays more expensive than later delivery? That's the moment a short position stops being a thesis and starts being a problem. If the physical market is already tight, covering turns ugly fast. The bid starts chasing offers that aren't really there. The market still prints trades, but the depth behind the prints is thinner than it looks. That's how short squeeze pressure builds in a calm market, not with panic candles, but with disappearing supply at the wrong time. And that's when the email arrives. Thursday night. I heard the rumors in the usual way, a few careful messages, a couple of hedged sentences, a warning from someone who never wastes my time. Friday morning, it became official, delivered in the most boring format imaginable, a margin, circular, no drama, no admissions, just new requirements and updated risk parameters. I call the reflex behind it Rule 4, 7b, a fictional label for a real pattern, the stability clause that activates when the system decides the fastest way to restore order is to change the cost of staying in the trade. Margin steps up. Position limits tighten. The public story is protection. The mechanical effect is forced selling. And the forced sellers are predictable. Anyone levered. Anyone holding silver exposure through proxies that behave like leverage in a volatility spike. Anyone who thought they were long a commodity, when they were really long a set of assumptions about how the paper layer would behave under stress. You could see it within hours. The tape looked calmer. The rally stopped looking like a rocket. By the close, it even looked contained, like the system had done its job. That's the trick of the paper market. It can stabilize the chart by flushing leverage without ever solving the underlying constraint. Then I checked what matters. Premiums didn't fall. Allocation didn't ease. Deliverability didn't improve just because the candle looked neat. The physical market refused to validate the "we fixed it" story. This is where the endgame splits into paths, and none of them are comfortable. In the first path, the system simply keeps hiking margin into volatility until it breaks enough paper demand to make the chart behave. It looks orderly. It looks responsible. It transfers the position from the levered crowd to the funded holders who can sit through the squeeze. The price may even pause. The shortage does not. In the second path, settlement engineering takes center stage. The market starts whispering about incentives, cash sweeteners, substitutions, delayed delivery language that turns ownership into a negotiable concept. It begins as a private conversation in London long before it becomes a public acknowledgement. This is where force majeure starts life as a rumor, because nobody wants to be the first to say the word out loud. In the third path, the squeeze ignores the levers and keeps tightening because physical demand refuses to blink. The shorts don't get relief. They get time pressure. The bid becomes desperate. The market makers stop managing narratives and start managing exposure. When that happens, price doesn't rise to make traders feel smart. Price rises to force behavior, to ration demand, the only way markets can when supply won't respond. Different paths? Same conclusion. The paper market can stabilize the chart, but it can't manufacture metal. That's why I kept returning to the same exhibit in my file. China already fired an emergency shot into London, 660 tons. It was supposed to change behavior. It didn't. The rally kept its spine. The physical conditions stayed tight. That means a bullet has already been spent that doesn't regenerate easily. When the next stress wave hits, the paper layer has fewer tools left besides rules, margin, and settlement engineering. And when you realize that, then you stop watching silver like a trade and start watching it like a legal dispute. Not because courts are involved yet, but because the outcome will hinge on definitions. What counts as delivery? What counts as ownership? What counts as settlement when the system is under pressure and everyone wants to be paid in something that can't be printed? A market doesn't announce it's switching from price discovery to survival mode. It just changes the rules of what ownership means. And once it does, the winners are decided in advance. I'm not here to sell you a price target. I'm here to tell you how to survive a market that can rewrite the definition of owning with a policy memo. If you've followed me through chapters 1 to 5, you already know why I sound less excited and more certain. We watched a supply shock that should have crushed price fail to do its job. We watched inventories drain in plain sight while the official narrative kept changing outfits. We watched premiums stay elevated like a lie detector that wouldn't shut up. We watched the paper system protect itself the way paper systems always do, through margin, rules, and settlement engineering. Strategy is not a prediction. Strategy is choosing the side of the market that cannot be negotiated away. So let me lay it out without romance, without hype, and without the temptation to turn this into a gambling story. When stress hits, the market doesn't punish the people who are right. It punishes the people who are forced. If you can be margined out, liquidated, or settled into something you didn't intend to hold, you don't control the timeline. And if you don't control the timeline, you don't control the outcome. That's why I start with a simple ownership ladder, because the entire game collapses into definitions when the system is under pressure. At the top is physical in hand, or allocated storage with clear title. Not exposure. Not tracking. Title. If you need permission to claim it in a crisis. It's not yours in the way you think it is. Next comes fully funded. Deliverable structures where applicable arrangements designed around delivery rather than convenience. With the funding and documentation to stand up when rules tighten, I'm deliberately not romanticizing this category, because structure is not automatically safety. The point is the intent. If the intent is deliverability and the funding is real, it carries less rule risk than pure paper exposure. At the bottom are paper proxies. They're liquid. They're easy. They feel modern. They also carry the most stress risk, because when the system shifts into survival mode, paper is where it can change the terms fastest. The more layers you put between yourself and the metal, the more rule risk you are accepting, whether you want to admit it or not. And that brings me to the one defense most people ignore until it's too late. Do not build a position that requires leverage to hold. I don't care how smart the thesis sounds. I don't care how confident the pundit is. If your position only survives as long as margin stays friendly, then your position is not a position. It's a rental agreement with a clearinghouse, and the clearinghouse can rewrite the rent overnight. Rule 4. 7B is my label for that reflex, and you've now seen it clearly. When volatility spikes and deliverability tightens, the system doesn't ask the market politely to calm down. It raises the cost of participation until the weak hands are forced out. The chart can look contained after that. The physical market stays tight. The winners are the funded holders who were never forced to sell into a rule change. So if you want to survive this kind of market, you stop chasing quotes and start prioritizing certainty. That doesn't mean you become reckless. It means you adopt a monitoring checklist that filters noise and focuses on the only signals that matter when a paper market is under stress. First, track persistent physical premiums and widening spreads. A stable premium is one thing. A premium that refuses to compress, or that widens while headlines talk about plenty of supply, is a system telling you the reference price is no longer the whole truth. Second, listen for allocation language and watch lead times. When 2 weeks becomes 4, when available becomes available for priority clients. When the conversation shifts from price to scheduling, you are watching a supply squeeze express itself in real life. Third, watch the curve for tightness signals, including backwardation behavior. The curve is the market's honesty test. It's where the system admits what it wants now versus later. Fourth, pay attention to unusual export license headlines and sudden emergency flow rumors. Normal markets do not need emergency flows. Emergency flows are what happen when the mechanism is being protected. Fifth, mark options-heavy price moves and gamma conditions on your calendar. Not because you need to day trade them, but because OPEX weeks are when a tight market turns into forced behavior. Schedules create stress points. Stress points reveal what the system is willing to do to protect itself. Sixth, watch industrial procurement behavior. When industry starts paying for priority delivery, it is telling you that substitution is limited and certainty is worth a premium. That is not a retail mood swing. That is a structural demand signal. If you do those things, you'll spend less time arguing with pundits and more time reading the plumbing. And that's the difference between being informed and being positioned. Now let's talk about the trap that wipes out more people than any margin circular, FOMO. FOMO makes people chase the quote. Pros chase certainty. If you chase the quote that you buy at the moment the crowd is loudest and the rules are most likely to tighten, if you chase deliverability, when you build a position you can hold through a rule change without becoming forced liquidity for someone else's exit. This is the simplest discipline I can give you. If you can't hold through a margin hike, if you're not positioned, you're rented. And here's the takeaway that ties the entire series into a single sentence you can carry with you when the next shock headline drops. Paper is a promise. Physical is a fact. In a force majeure world, promises get renegotiated. Facts don't. I'm not telling you this to scare you. I'm telling you this because you now have enough evidence to stop being surprised when the system chooses itself. It always will. That isn't malice. It's structure. So the next time you see a headline screaming that massive supply hit the market, don't ask whether the price moved. Ask whether the metal moved, because the day those answers diverge is the day the transfer begins. I'm not here to sell you a price target. I'm here to tell you how to survive a market that can rewrite the definition of owning with a policy memo. What matters now isn't whether you can predict the next candle. It's whether you can stay standing when the rules change mid-trade. Because when stress hits, the market doesn't punish the people who are right. It punishes the people who are forced. If your position can be margined out, liquidated, or quietly converted into something you didn't intend to hold, then you don't control the timeline. And if you don't control the timeline, you don't control the outcome. So I'm going to turn everything we've just documented into a disciplined playbook. No hype. No hero fantasies. Just a decision tree that works in a market where paper can stay liquid while physical gets rationed. Start with the ownership ladder, because that's where rule risk lives. At the top is physical in hand, or allocated storage with clear title. Not exposure, not tracking. Title. If your claim depends on someone else's discretion during stress, then it's not ownership in the way most people assume it is. Next comes fully funded. Deliverable structures where applicable arrangements designed around delivery, not convenience. With funding that doesn't depend on rolling leverage. I'm careful with this category for a reason. Structure can reduce risk, but structure can also hide it. The test is simple. In stress, does it move you closer to metal, or does it keep you trapped in promises? At the bottom are paper proxies. They're clean, liquid, and psychologically comfortable. They're also where the system can change the terms fastest, because paper is the layer built to be adjustable. The more layers you put between yourself and the metal, the more you are betting that the rules will stay friendly. Now, the defense that matters more than any clever thesis. Don't build a position that requires leverage to hold. I don't care how smart the narrative sounds. If margin can force you out, you don't control the timing. And if you don't control the timing, you become liquidity for the system right when the system needs it most. That's the trap. People think they're positioned for upside, but they're actually positioned for someone else's survival. That's why risk management is not a neutral phrase in a tight market. When volatility rises and deliverability tightens, the referee doesn't have to ban you. It just has to make holding expensive enough that you leave. The chart can look calmer after that. The physical market can stay tight. Both of those things can be true at the same time. So strategy isn't about chasing the loudest price move. It's about prioritizing certainty. Here's the monitoring checklist I use: signals, not noise. First, watch persistent physical premiums and widening spreads. A premium that refuses to compress is the market pricing certainty, not optimism. When headlines claim supply is flooding in while premiums stay elevated, the reference price is no longer the whole truth. Second, listen for allocation, language, and track lead times. When available becomes available for priority clients. When 2 weeks becomes 4, when cash buys a place in line instead of a shipment. You're watching rationing. Enter the system. Third, track tightness signals in the curve, including backwardation behavior. The curve is where the market confesses what it wants now versus later. In stress, the near term becomes expensive for a reason. Fourth, take unusual export license headlines and sudden emergency flow rumors seriously. Healthy markets don't need emergency flows. Emergency flows happen when the mechanism is being protected. Fifth, mark options-heavy price moves and gamma conditions on your calendar. You don't need to day trade them to respect them. OPEX weeks create predictable stress points where forced hedging and margin interact with thin physical buffers. Sixth, watch industrial procurement behavior. When industry pays for priority delivery, that is not a retail mood swing. That is structural demand expressing itself through money and contracts. If you do those things, you'll stop outsourcing your understanding to pundits and start reading the plumbing. That's how you avoid being late. Now, a word about FOMO, because FOMO is the emotional lever the system uses against people who don't have a plan. FOMO makes people chase the, quote, professionals chase certainty. Chasing the quote means you buy when the crowd is loudest and the rule risk is highest. Chasing certainty means you build a position you can hold through a memo, a margin hike, or a settlement change without being forced to sell at the worst moment. Here's the discipline in one line. If you can't hold through a rule change, you're not positioned, you're rented. And that's the core takeaway that fits everything we've witnessed. Paper is a promise. Physical is a fact. In a force majeure world, promises get renegotiated. Facts don't. The next time you see massive supply hit the market, don't ask if the price moved. Ask if the metal moved. Because the day those answers diverge is the day the transfer begins. I watch the market's red screens flicker. Then I feel the cold weight of silver in my hand, and the silence finally makes sense. They called it liquidity, leverage, protection, until one memo changed the rules and the ownership on the screen turned into a negotiable claim. I learned the hard way that fiat is a promise, but physical silver is a fact, and facts don't get renegotiated in a panic. So, hold what you can actually claim, and carry that certainty like a key, because it doesn't just buy metal, it buys freedom. And don't keep that freedom to yourself. Tell the people you care about before the next schedule hits and the door quietly locks.